Imagine this. Your grandparents bought their first house for $25,000. Today, that same house costs $400,000. Your parents filled up their gas tank for $15. You're paying $60.
A movie ticket used to be $3. Now it's $15. What if I told you this isn't random, isn't just the economy, and definitely isn't your fault, but there is something you can do about it? Most Americans are watching their money lose value every single year and have no idea how to fight back. Until now.
Hey everyone, welcome back to the channel. Today, we're tackling the silent killer of American wealth, inflation. But we're not just talking about why prices go up. We're going to break down exactly why your paycheck doesn't stretch like it used to, who benefits from this system, and most importantly, the specific strategies you can use to protect and grow your wealth even while everything gets more expensive.
This video is for anyone who's ever thought, I'm making more money than ever, so why do I feel broke? Whether you're in your 20s trying to save for a house, in your 30s juggling kids and bills, or in your 40s stressing about retirement, this affects you.
By the end of this video, you'll understand the real mechanics of inflation. You'll see through the BS numbers the government reports, and you'll have 5 concrete actions you can take this week to stop inflation from stealing your future. Let's break this down.
How we got here. A brief history of American inflation. So let's start with how money worked in America, because understanding the past makes the present crystal clear. The gold standard era, 1879 to 1971. For most of American history, dollars were backed by gold. Every dollar represented actual physical gold sitting in a vault. This meant the government couldn't just print money whenever they wanted, because they'd need the gold to back it up. Inflation existed, but it was slow and predictable.
Here's what that looked like in real life. In 1913, the average home cost about $3,400. Adjusted for the limited inflation that existed then, prices were relatively stable for decades. The Nixon shock, 1971. Then, in 1971, President Nixon did something radical. He took the US dollar off the gold standard. Suddenly, money became what economists call fiat currency. That's just a fancy way of saying dollars are only worth something because the government says they are. There's nothing physical backing them anymore. Now this is where it gets interesting. Once that restraint was removed, the government could print as much money as they wanted. And guess what they did? They printed. A lot. The numbers are staggering. In 1971, there were about $50 billion in circulation. By 2000, that grew to $600 billion. By 2020, it hit $4 trillion. Today, in 2026, we're over $21 trillion in circulation. That's a 420x increase in 55 years. Your salary didn't increase 420 times, did it? Here's the crazy part. This wasn't accidental. Every major economic crisis, the 2008 financial crash, the 2020 pandemic, the 2022 inflation surge, the solution was always the same. Print more money. The Federal Reserve calls it quantitative easing. Regular people call it, why does everything cost more? In 1970, the average American worker made $6,670 per year. A new car cost $3,500, about 52% of annual income. Today, the average worker makes $56,000 per year, but a new car costs $48,000, about 86% of annual income. You're working harder to buy the same thing. The transition is clear. We moved from a system where money held stable value to a system where your money loses value every single year by design. And that brings us to today. The real inflation rate versus what they tell you. Let's talk about the elephant in the room. The government lies about inflation. Not in a conspiracy theory way, in a technically true but practically useless way. The government reports inflation using something called CPI, Consumer Price Index. Right now, they're saying inflation is around 3.4%. Sounds manageable, right? Here's what most people don't realize. CPI doesn't measure what regular Americans actually buy. It's a weighted average that includes things you might buy once every few years, while downplaying the stuff you buy every single day. What CPI downplays: food, you buy this weekly; gas, you buy this weekly; housing, your biggest expense; healthcare, getting more expensive rapidly; education, crushing Americans with debt. What CPI includes to make numbers look better? Electronics. TVs get cheaper, but you buy one every 5 years. Clothing also gets cheaper, less frequent purchase. Various goods that deflate in price. The real numbers. Let's look at what actually matters to your life. Rent/housing, up 30–40% in most major cities since 2020. Groceries, up 25–30% since 2020. Gas, fluctuates wildly, but up 40–60% from pre-pandemic. Healthcare, up 20% since 2020. Childcare, up 15–20% since 2020. Car insurance, up 26% since 2020.
Do those numbers look like 3.4% to you? No, because real inflation, the inflation you experience, is closer to 8 to 12% per year for the past few years. Common mistake people make: they trust the CPI number and think, if inflation is only 3% and I got a 4% raise, I'm getting ahead. Wrong. If real inflation is 10% and you got a 4% raise, you just took a 6% pay cut. What financially smart people do: they track their own personal inflation rate. They look at their actual expenses year over year and calculate their real cost of living increase. This tells them the truth. Action step for beginners: pull up your bank statements from January 2023 and compare them to January 2026. Look at the same categories: groceries, gas, rent, insurance. Calculate the percentage increase. That's your real inflation rate. Have you ever noticed how your grocery bill keeps climbing even though you're buying the same things? That's real inflation, not the government's number. Drop a comment if your expenses have exploded in the past few years. Where your money actually goes: the hidden tax. Here's something almost nobody talks about. Inflation is essentially a hidden tax. Let me explain this clearly, because it's one of the most important concepts in finance. When the government prints money, they don't send you a bill. They just make all your existing money worth less. It's like if you had a pizza cut into 8 slices, and someone came along and cut it into 16 slices. You don't have more pizza, you just have smaller slices. Here's how it works. You have $10,000 in savings. The government prints trillions of dollars. Now your $10,000 represents a smaller percentage of the total dollars in existence. So even though you still have $10,000, it buys less stuff. That's inflation. But here's the crazy part. The government benefits from this. Here's why. Debt gets cheaper. The US government owes $34 trillion. If inflation is 5% per year, that debt becomes easier to pay off because they're paying it back with dollars that are worth less. Tax bracket creep. As your salary increases to keep up with inflation, you move into higher tax brackets, so you pay more taxes even though your purchasing power stayed the same. Asset prices rise. The government and wealthy people own assets: stocks, real estate, businesses. Inflation makes these assets more expensive in dollar terms, making them richer on paper. Who gets hurt? Regular workers whose wages don't keep up. Savers with money in checking savings accounts. Retirees on fixed incomes. Anyone who doesn't own assets. Real-world scenario. Let's say you're 30 years old, making $60,000 per year, with $20,000 in savings. Without action. After 10 years of 8% real inflation, that $20,000 has the purchasing power of about $9,300. You lost over half your money without spending a dime.
Your salary might increase to $80,000, but with 8% annual inflation, you need $129,500 to have the same purchasing power.
With smart action, you invest that $20,000 in assets that grow faster than inflation. You negotiate raises that match real inflation, not CPI. You move money out of cash and into value-storing assets. Does this sound familiar? Are you watching your savings lose value while prices climb? Let me know in the comments which category hits you hardest: groceries, rent, or gas.
Point 3. The asset owner versus the wage earner. Now this is where it gets interesting, and this is the key to understanding why the wealth gap keeps growing. There are two types of people in the economy. Wage earners trade time for money, most Americans. Asset owners own things that generate money, the wealthy. Here's the brutal truth. Inflation destroys wage earners and enriches asset owners. Why? Wage earners get paid in dollars that lose value. Asset owners own things, stocks, real estate, businesses, that increase in price with inflation.
The math. Wage earner example. Makes $50,000 a year in 2020. Gets 3% annual raises. Makes $57,964 in 2026. But real inflation was 10% per year. Needs $88,450 to maintain purchasing power. Lost 34% of purchasing power despite making more money. Asset owner example. Owns $100,000 in index funds in 2020. Stock market averages 10% annual returns. Has $177,156 in 2026. Even with 10% inflation, they're ahead in real terms. Their wealth grew while wage earners shrank. Common mistake. People think, I can't afford to invest, so I'll just save cash. This is exactly backwards. You can't afford not to invest, because cash guarantees you lose to inflation. What smart people do, they shift from being pure wage earners to being wage earners who also own assets. They invest every month, even if it's just $50, buy real estate when possible, start side businesses that can be sold, own dividend-paying stocks, hold commodities or gold as hedges. Real-life comparison. Two friends graduate college in 2015. Friend A, wage earner only, gets job at $45,000, saves $500 per month in savings account, has $54,000 saved by 2026, lost purchasing power due to inflation, still trades time for money. Friend B, wage earner plus asset owner, gets same job at $45,000, invests $500 per month in index funds, has $89,000 by 2026 with market returns. Money worked for them while they slept, built wealth that compounds. Same income, same discipline, completely different outcomes. The only difference? Friend B understood that you have to own assets to beat inflation. Which one are you? The saver getting destroyed by inflation, or the investor building wealth? Comment below and be honest. Point 4. The psychology of slow theft. Here's what makes inflation so dangerous. It's slow, it's invisible, and by the time you notice, you're already way behind. Think about it like this. If someone stole $500 from your wallet right now, you'd be furious. You'd call the cops. But if inflation steals $500 of purchasing power over a year, you barely notice. You just think, everything seems more expensive. The boiling frog effect. You know the old story. Put a frog in boiling water, it jumps out. Put a frog in cold water and slowly heat it up, it doesn't notice until it's too late. That's exactly what inflation does to Americans. Real numbers to prove it. 2000. Median home price was $119,600. 2010. $222,900, 86% increase. 2020. $329,000, 47% increase from 2010. 2026, $417,700, 27% increase from 2020.
That's a 249% increase in 26 years. Did your salary increase 249%? For most Americans, absolutely not. The psychological tricks. Nominal thinking. You focus on the dollar number. I make $70,000 instead of purchasing power. But $70,000 buys what $50,000 did in 2015. Anchoring bias. You remember what things used to cost and think current prices are temporary or inflated, when really, this is the new normal. Delayed impact. You don't connect today's Fed policy to next year's grocery bill, so you don't take protective action.
What smart people do, they accept reality. They don't wait for prices to go back down, because they won't. They don't hope for wages to catch up, because they won't. They take matters into their own hands. Action mindset shift. Stop thinking, I'll invest when I have more money. Start thinking, I have to invest now, or I'll never have more money.
Most people don't realize this, but the difference between financial security and financial stress is often just understanding this one concept. Your money is melting like ice cream in the sun. You have to move it into containers, assets, that don't melt. Have you ever noticed how things that seemed expensive 5 years ago now seem normal? That's the psychology of inflation conditioning you to accept less. Comment if this is hitting home.
Point 5. The Fed's role and why you should care. Let's talk about the Federal Reserve for a minute, because they're the ones pulling the levers that directly impact your wallet. The Fed has two main jobs: control inflation, keep it around 2%, and maximize employment. Here's the problem. They've completely failed at number 1 for years, and they use number 2 as an excuse. How the Fed creates inflation. They print money, officially called expanding the money supply. They lower interest rates, making borrowing cheap, which increases money in circulation. They buy government bonds, injecting cash into the economy. Why they do it? To stimulate the economy during recessions, to keep the government funded by buying their debt, to prevent deflation, which they fear more than inflation. The problem for you, every time they do this, your dollars lose value. You didn't vote for this. You can't opt out, but you absolutely feel the consequences. Recent history. 2020 to 2021, the Fed printed $4 trillion plus in response to the pandemic. 2022 to 2023 realized, oops, inflation is out of control. 2024 tried to fix it by raising interest rates, making loans expensive. 2025 to 2026, now they're stuck. Inflation is still high, but raising rates more could trigger a recession. What this means for you: your mortgage or rent costs more. Your credit cards charge more interest. Your savings accounts earn a little more, finally. But inflation is still outpacing your earnings. Practical example. In 2020, smart investors locked in 3% mortgages on rental properties. Now those properties have appreciated 30%. Rents increased 25%, but their mortgage payments stayed the same. Meanwhile, their tenants' rent kept going up. That's using the Fed's policy to your advantage. The Fed won't save you, but understanding what they do gives you the playbook to protect yourself.